The bond market is screaming. Is anyone listening? Nothing moves in isolation. The U.S. 30-year Treasury sits near 5.28%, a 19-year high. Japan's 10-year JGB hit 2.93% this week, the highest since 1996. The UK 30-year gilt spent this year grinding to levels last seen in 1998, and the 10-year gilt is near 5.06% on hot oil and sticky inflation. 3 sovereign bond markets, 3 different central banks, 1 direction. That's not noise. That's a signal. The why is boring, and that's the point. No single shock is driving this. It's the same problem showing up everywhere: government spending more than they collect, inflation refusing to fully die, and bond buyers finally demanding to be paid more for holding 30-year paper. The U.S. posted its highest monthly deficit since March 2021. The UK keeps trimming growth forecasts while issuing heavy gilt supply. Japan has a weak yen, tariff-driven inflation, and a central bank now being forced to consider hiking off near zero. Different countries, same route: too much debt, too much supply, not enough conviction. Inflation is beaten. Here's what people skip. When long yields rise together across the US, UK, and Japan, it isn't just a bond story, it's a cost of capital story for everything. Higher discount rates compress equity valuations, especially long-duration growth names. It also pressures carry trades. Japan's move already echoes August 2024, when a BOJ hike plus weak U.S. jobs data knocked the Nikkei down over 12% in a session and dragged the S&P with it. If Japan hikes in September as markets now expect, that risk stops being theoretical. Show me real numbers, though. The U.S. Treasury ran buyback operations to calm long-end yields, and the relief faded fast. Yields simply rebounded once the intervention wore off. That tells you demand at the long end is structurally weak, not just spooked. The UK faces the same pattern: heavy issuance meeting weak appetite from pension funds, the natural buyer of that duration. Weak demand plus heavy supply plus a patient central bank doesn't resolve quietly. Jackson Hole is the next catalyst. Kevin Warsh's keynote on August 27 to 29 will be parsed for how a newer Fed voice weighs inflation risk against a bond market already under stress. Hawkish or neutral, yields likely push higher. Any hint of concern for financial stability or fiscal strain, and that's the first real chance for relief. Nothing to do right now except watch. This is a patience setup, not an action setup. What matters is whether this is a genuine regime shift in term premium, or a stretch trade that snaps back once one central bank blinks. Jackson Hole doesn't need a final answer, just a signal for which story the market believes heading into September. Let them panic on the headlines. We watch the auctions and what actually gets said next week.